What's up, everyone? It's Eric from Option Edge, and in today's video, we're going to do some myth busting. We're looking at investing with Henry, a YouTuber who talks about trading options, and we're going to look at his most popular video and see if we can sort of pick it apart and see if we can bust some myths. Okay, so let's go. Today, I want to talk about investing with our friend Henry. Came across his page on YouTube just as I was going through some options content, and he's got a pretty good following here, 207 subscribers, 207,000 subscribers. And I looked at his popular videos. He's got a video with almost 1 million views within the last year, and this is the video. And basically, let's go into it and see if we can find any sort of myths or maybe not outright lies. I'm not going to call this guy a liar, but there's some things that he omits that that a lay person or someone new to trading options isn't going to catch. And in today's video, we're going to point those out. Let's go. All right, here we are, investing with Henry, his most popular video. Let's give it a watch and see if we can add any nuance to what he is saying.
So people think that you need a large portfolio to make a lot of money.
All right, first myth. Do you need a large portfolio to make a lot of money? Well, think about this. If you had $100 and you were able to turn your $100 into $1,000, $5,000, $10,000, $20,000, $50,000, what type of returns would you need to get to achieve that type of money? So $100 to $1,000 is a 10x return. How many things are there that you can invest in that will give you a 10x return? Okay, so think about that, and that's sort of where I'm getting at. So in other words, in order to get a lot of money, you need ridiculous returns. And if anyone could make ridiculous returns with a little bit of money, everybody would have money. Let's go on.
And I want to debunk that myth because it's actually just not true. You can actually turn a smaller portfolio into a medium and a larger portfolio. It just takes skill, knowledge, taking proper risk, managing your losses, and of course, risk management. And the combination of these things will allow you to grow a small portfolio, because it's not like you have to have a 7-figure portfolio like me to see some good returns. I'm going to be showing you a few different trades on 3 different stocks that I think is a very good trade. And in fact, I would place that trade if the market weren't closed right now. But as soon as the market opens up, I'm actually going to be making these plays. All right, so the first thing that I want to show you guys is I'm going to open up AAL. And the reason why I want to open up American Airlines is because the strategies that I'm going to be using today, well, one of the assumptions is that the stocks are not going to tremendously shoot up or fall. Basically, our assumption is that a stock is going to continue to go sideways. In fact, all 3 strategies that I have today is going to consider that a stock is going to go sideways, because part of that reason is I think the market is high, but I also don't see any catalyst for it to fall any lower. So I think the market will trend sideways. But anyways, you can pick your own stocks. This is just me showing you what I'm going to be doing and my thought process. You don't have to copy this. By no means am I a financial advisor. Just go ahead and learn everything that you can and then apply this knowledge to your own stocks and your own watch list. So taking a look at American Airlines, it has had some volatility. However, what I've noticed is as soon as it jumps up, it always tends to fall back down. In fact, if I go to 6-month chart, it pretty much hasn't gone anywhere in the past 6 months.
Okay, he said a good key term that we should listen to. He said the stock hasn't gone anywhere in the past 6 months. So that what that's telling me is volatility has gone down in this name compared to maybe in the last year. It was moving around more. But overall, it's safe to assume that volatility is low. And when volatility is low in an underlying stock, that means as a option seller, if you're selling theta, short options, puts, calls, credit spreads, etc., when volatility is low, you will be compensated with less of a credit as an options trader, okay? When volatility is high and these underlyings have more ability to move because the volatility is higher, you will get compensated with more credit as an options trader. So don't let our friend Henry here try and make you think that, hey, volatility is low, the stock isn't going to move much, so if we just sell theta, then we should make money all day. But what the reality is, you're going to make less money when volatility is less high, when it's lower. Okay, so remember that. That is a key point to know.
Start off around $25, but if you take a look right over here, I'm going to scroll down right now, around July 19th, this stock is still trading where it's been on July 19th. So for the past 4 months, this stock has gone up, down, up, down. It's pretty much traded sideways, gone up, and then back down, up, and then back down. And
again, he's saying the stock has traded within a small range, sideways. So therefore, again, that's him saying that the volatility is low in this stock.
Up and then back down. And I kind of understand that this pattern is going to continue with American Airlines. I don't see any reason that it's going to fall too much lower. I don't see any reason why it's going to jump back up in the next couple of days.
This is sort of another fallacy in thinking. He thinks since volatility is low right now, he believes that volatility will continue to be low and you won't see large swings in price action, which in reality he has no idea. And I would argue that in a state of low volatility, you're more likely to go to a state of higher volatility, which is why it's better to sell premium in states of very, very high volatility. Okay.
Or pretty much a week. So this is about a week. This is about a couple week period right here. This is from the 16th and this is going back to the 16th. So this is an entire month where American Airlines has traded sideways. Essentially, that is the thesis for American Airlines. That's where I'm going to be starting here. I'm going to go to Trade American Airlines Options, AAL Options. Now, you can pick any date that you really want. I typically like to go for weekly options or bi-weekly options. The reason why I like to go for weekly options is because not a whole lot of stuff can happen in a given week. I mean, unless it's
he likes to use weekly options because not a lot of stuff can happen in a given week. That's another word for there's not as he's trying to say the stock can't move up and down as much in a shorter time frame. That is true. It's less likely for a stock to move $20 like this, a $20 stock. It's going to be very unlikely for the stock to move, let's say, $5 in a week. And it would be more likely for the stock to move $5 in, let's say, a month or 2 months. But since that is the case, the market knows that you are going to receive less credit on the options you're selling. Okay, there is no free lunch in the market. If the stock is going to move less, you will receive less credit while selling options and hence make less money.
there's an event like maybe earnings or there's a Fed meeting, then there's usually not a whole lot of events that can turn an option upside down. And if the option doesn't go in my favor, I can always set a stop loss. I can always close the position. And it's much easier to monitor a position in a given week than have a option that is out for a month or 3 months. That longer term time period is just harder to trade because it's easier to bet on a stock going sideways in a given week than for a stock to go sideways in a whole month or a whole 3-month period. So
Again, the longer the time frame you're trading, the more credit you will receive because you're taking on more risk. Okay.
now I'm going to look at the option chain. And again, as an option trader, my assumption here is that the stock will move sideways. So the first thing that I'm going to do is I'm going to sell a call option that is near the money. So right now, American Airlines is $19.53. I'm going to sell the 19.5 strike, and that's basically at the money. It's only 3 cents off. So I'm going to click right here. It's going to be worth $30. And I'm going to click sell. This is going to be $30. And now what I'm going to do, this is very important. I'm going to go buy a call option. You guys will see I'm going to enter a custom order. So this option strategy is going to be a custom order, and you're going to see on the right side right over here the exact payoff, the risk that I'm taking, and the profit that I'm going after. Okay, so going for buy call option, I'm going to buy a leg above and a leg below. This is going to be important when you guys see this strategy actually play out. Getting started here, 19 strike. This is the leg below the 19.5 that we have open. So I'm going to open up this call option right here. This is going to be a buy. Now I'm also going to buy the 20 call option right here. Now, if you notice, the cost is 42, but what I'm going to do is right here where you see this custom order, there's a little drop down menu here. I'm going to go to custom. Rather than a 1-to-1 ratio, I actually don't want to open up 1-1-1. I'm actually going to go ahead and sell 2 19.5s. going to the custom, clicking right here, going right here where it says 19.5, the option that I have sold. I basically want 2 of these sell orders to account for this 1 and 1 buy order. All right, cool. Now that we have entered that, I'm going to scroll down and you guys can see that this is a very beautiful chart, and I'm going to explain it right now. The max loss right here is $12. However, your max profit is $38. So as you guys can see, in this example right here, you can triple your money. You can
Okay, so he talks about how much you can lose and how much you can make, and it's over. You can your max profit is more than 3 times than your max loss. But what he fails to talk about is what is the probability of achieving max profit? What is the probability of achieving max loss? And let's go into let's just do a hypothetical trade ourselves and just see what the probability of selling a weekly $1 strike wide option contract in ALL would be like. Okay, here we are in Tasty Trade. So this is American Airlines. This is the stock he was referring to. We just have the January 6th, a weekly expiration date. And granted, the stock has gone down like 40% since he made that video. So he was dealing with strikes around the 20s. We're dealing with strikes that are lower. But if we construct a butterfly spread just like he did, we're selling the at the money calls, selling the strike above and the strike below for a total width of $1. So let's look at the probability of us making money on this trade. So here's the pop. It's about 36%. Our max loss on this trade is $14. Our max profit is $36. So basically, we have a 1/3 chance of making money. We're most likely going to not make money. We have a 64% chance of making $0. Okay, so that just keep probability in mind when people are discussing how much you can make and comparing risk to reward in these trades, because they fail to talk about the probability. So that was the first trade he showed. He shows a couple other trades, but overall you can see that he doesn't mention anything about implied volatility, which as an options trader is basically almost as big of a deal as price movement itself. And then on top of that, he doesn't talk about the probability of any trades. He just talks about how you can 5x your investment. But a lot of these trades, if you're going to 5x your investment, your probability of doing that is going to be very low. So overall, he neglects a lot of things and tries to insinuate that there might be some sort of free lunch out there. So just something to be aware of. All right, peace out.